this episode, I want to talk about something that a lot of people don't like to talk about, but that is day trading losses. And unfortunately, it's something we need to talk about because the statistics are not very good. Here's the cold, hard truth here. The fact is that 90% of all new day traders don't make it past their first year as day traders because of day trading losses. Kind of obvious when you think about it, but when you think about it, it's not the winning trades that are going to make you lose money in the stock market and not make it as a day trader. It is the fact that you let the losers get so big and so bad that they cost you so much money that either you had to stop day trading because you fell below the 25K equity required for day traders as pattern day traders, or you just simply lost so much money that you just can't afford to do it anymore. So the question is there any way to limit these losses? And of course the answer is yes. There are automatic stop losses. And in this video I'm not going to cover extensively everything that needs to be covered here, but I want to get the ball started, get it rolling and get you to start thinking about some of the things. The first thing about automatic stop losses is this, and it means that you accept several key facts, and these facts underlie everything else that I'm getting ready to tell you. One is the fact that the trade could go against you, and that's the hardest thing for new traders to realize, is that every trade is not going to be a winning trade. If only, right? We wish it were so, but it's just not true. And when you accept the fact that that's not going to happen, that trades are going to go against you, then you have to do something to stop the bleeding so that you don't lose too much money. Second thing that you have to accept is there's an amount of money that you're willing to lose on each trade. It may be different on each trade. It may be a set percentage. It may be a set amount. But if you're going for a $100 win on each trade, for example, you may only be willing to lose $50 in case you're wrong. So that's a concept you need to accept. And then the third is that you are not a disciplined trader. As much as you may think that you are, or that you want to be, the fact is that we're human beings and we're very susceptible to rationalizing our own behavior and talking ourselves out of that losing trade. Well, because we've all had that self-talk of, well, I'm losing so much now I can't get out of the trade, and then you keep holding on and you keep holding on, and the day trade becomes a swing trade, and you end up losing a whole lot more money a week later than you would have on the very day of the trade if you'd simply set a limit to how much you're willing to lose. So the various types of stop losses, and just cover a few of them here. One is the physical stop. The physical stop is where you actually set it with your broker, and each broker is different as to how you do this. And I won't go into that for each broker, of course, but physical stop is where you actually draw a line. You say, if it goes to this price, then I'm out of the trade, period. No argument, that's it. A mental stop is where you kind of draw an imaginary line on the chart and you say, well, if it goes to that price, then I'll get out and I'll exit the trade on my own, but I'm not going to set a physical stop. The problem with this idea, of course, is that we tend to talk ourselves out of those mental stops. And if you do that, then you're going to be in trouble. The third idea is a movable stop. A movable stop is where you say to yourself, okay, I'm gonna get out here, but as the trade moves either in my favor, I'm gonna move the stop, or if it moves against me, I'm gonna move my stop. And then a trailing stop is where you have a certain set percentage or dollar amount from which you say, I'm only willing to let it go that far, and if it moves by a set amount, then I'll get out of the trade. So bottom line, accept the fact that all of your trades will not be winning trades. Set a limit on how much you're willing to lose on any one trade, and then it's not the winning trades that ruin your equity position, it's the losing trades.